Hi, everyone. Welcome to another Dolphin Financial Radio Show. I'm Dan Wendell, owner of Dolphin Financial Group. Today, we're going to be talking about interest rates going up and the impact that's having on short-term annuities. Now, annuities, there's a ton of different types out there. I'm going to talk specifically about fixed rate, short-term. We're talking 2, 3 years annuities. And I want to talk about how this current interest rate environment is impacting the pricing of those or the interest you get on those. To help me talk about, I mentioned the A word, right? No one likes to talk about the A word. And speaking of A words, let's bring in my sidekick, Anthony. Hey, it's Anthony. He's got to turn his microphone on.
The real name is Anthony.
There we
I was
go.
just
Were you
but
thinking I was thinking something else when I was talking about the A word with annuities?
you said a dirty word, the A word, annuities. So I've got the buzzer ready, and
Love it.
you made fun of me and used my real name, so you're gonna get another one just for
Love it. So
the
I
principle of the matter. My mother is the only one that calls me that, especially if she uses the middle name as well.
oh,
Anthony Thomas, then
oh, yeah, then you
I
perk
am
up.
in big trouble. It's nothing but noise over here on my side today, folks. I
Well,
understand that.
I'm giving you an out, I'm giving you an out because we're talking about interest rates and annuities. Like, I don't know, Tony,
Ooh.
if you head for the door, I think we'll be fine. I think everyone would understand it.
Well,
But
I think it's important though because there are some people out there that certain types of annuity can be the exact fit they need to help them in retirement. That's my opinion from what
yeah.
I've heard, but I do also know there's an even dirtier word is variable. So we can talk
Yeah,
about
there's a
that
lot
too.
of types of annuities, and the interest rate increases impact all types of annuities,
So
but
when the Fed raised the interest rate a half a
right.
percent,
What did that do? What
is
did
that
that do to
affecting
short-term
annuities?
rates? Like, if you look at the bank, what did it do to the bank rates? Did your interest rate go up at the bank?
Not much.
I mean, probably went up 1,000% from 0.001 to point zero zero one
Oh,
one.
I just read an article actually, Dan. I can throw out an actual number, 0.06 to close to zero point 0.5 on some things. Ooh.
Well, I mean, so from a tenth of a point to half a point, it's
Yeah.
not that's a big increase, right?
And that's not every bank now. That's just an
Right, right.
example of in some banks and some accounts that can happen. And there's a lot of, depending on how much money you put in and for how long,
Right,
there's a
right.
lot of factors that
Well,
banks use, but CDs also haven't gone up very much, if at all. So, I mean,
right.
yeah,
But we expect something to happen with these interest rates. So that's
sure.
what I want to talk about. I'll put the show up here on short-term savings. We've done shows on what do we do with short term, and one of them is these short-term annuities I want to talk about. But before I get into it, just a public service announcement. You know, it's impacting all types of annuities, but one thing that people don't realize is pension is an annuity stream. And so when you are close to retirement, you might get an option to take an annuity payment or a lump sum buyout. We've done a show on that. Is a pension better than a lump sum? And a lot of times, um, it all depends on the interest rate environment. So the fact that
Right.
interest rates are going up, your annuity payment might be actually a better play than the lump sum. Something you don't hear very often from advisors, because usually it's just take the lump sum and we'll do better. But if you do the math in a rising interest rate environment, you got to you got to do a double take on this because this
Mm.
is a big lifetime decision, right? But that's for another time. But keep that in mind. That's very important that as interest rates go up, you got to think twice about your pension payments because those change. People don't
Mm.
realize that those
Yeah, I
pensions
never thought of it affecting your pension. Um,
absolutely
yeah,
before you take the pension, right?
right.
Before you take the pension, unless you have a cost of living adjustment of pension. But when you're at that point where it's like, do you want a lump sum or you want the payment for life? Interest rates factor in along with your life expectancy. So,
Sure, sure.
okay. So today I want to talk about MYGAs. You ever hear these, Tony?
Mhm.
MYGAs, MYGAs. That stands for multi-year guarantee annuities. So as interest rates go up, which they're doing now, Fed raising rates, We saw mortgage interest, go up. So do rates on MYGAs. So do rates. So
I thought
what
it
is
was
a
my
MYGA?
gas. I thought you were gonna say my gas.
There's a lowercase s there, Tony. For the listeners, there's a lowercase s. MYGA lowercase s. You thought it said MAGAs. Make annuities great again.
There wow, you came up with
Wow. Wow.
we gotta have some kind of, I don't know, we need to celebrate. Dan made it funny. Hey, Dan said something that's actually humorous on the show. We've gotta have a where do I have the sound effect for
Tony,
when Dan
that's I
accidentally
don't want to diminish your role here on the show, so I
when
can't. I got to make sure. Love it. All right. So let's talk about what MYGAs are. They're multi-year guarantee annuities, but they're
make
also
annuities
known
great again.
they're also known as CD type annuities. So people know what CDs are, and we did a show. I'll put that up here. What is a CD? Because some people don't know what that is, but
Sure.
check it out. And some of the
Compact
comments on
disc.
there were like, "Why are you spending so much time?" You made that joke then. That's like the fifth time you made that silly joke, but it wasn't funny then. It's still not funny. So,
Okay, Mitch.
so what are MYGAs? Right. So MYGAs are basically, and I'll put some information on here. They're issued by an insurance company, not a bank, right? So that's big, like right away, huge difference there. So when you go into a bank and they're talking about CD rates, they're not going to talk to you about MYGA rates unless they have an affiliation with an insurance company, right? These are not FDIC insured, right? So this is not going to be covered under the bank auspices. You're going to be buying it with an insurance company, so it's based on the insurance company itself. You got to deal with them, right? So that's important to note. But the interesting part about a MYGA is it's a set interest rate for a term, kind of like a CD. That's why they call them CD-like or CD type. A MYGA will say, here's your interest rate for 3 years, 5 years, 10 years, 2 years. So you choose the term, and it's guaranteed interest rate for that time. You're not going to get more. You're not going to get less.
So if you
Okay.
lock in a good rate and you need the money in the short term or in 3 or 5 years or 10 years, it might be a good thing.
Well, here's the deal. Yes, if you time it right, but if you time it wrong and you say, I'm going to buy a 5-year MYGA and you need the money in year 2, there's the problem. Some so they have surrender penalties. Unlike a CD where you lose 6 months interest usually, a MYGA is an insurance product, so it's going to be, hey, here's a surrender penalty, and it's pretty stiff depending on what you're doing, right?
So there's you don't have a liquidity option that you do with some other types of
Right. You do have liquidity options on some of them, but they're not as strong as like a CD, right? So they're less liquid because they're an annuity, right?
Right. That's what I was saying.
And then finally, they're tax deferred. So when you buy a CD and you're getting interest, you say, I don't want the interest. I'm not going to touch it. The bank's going to 1099 you for the CD interest, whether or not you take it, right? Whether or not you roll it in or take ownership of the interest. Whereas a MYGA is not going to give you a 1099 every year if you just let it sit there. It's not until you take the money out that you actually pay taxes on it. So if you have a 5-year MYGA, you don't pay any tax on any of the gains, any of the interest until the 5th year when you take the money out. If you take the money out, you can roll it to another one, so on. Okay. So MYGA terms are typically 2 to 10 years. And the longer you go out, the higher the interest rate. But in today's environment, I've really been focusing on the short term, 2-3 year terms, maybe a 5-year term if someone's got a specific goal. I'm going to move in 5 years and I need this money for a down payment on my house. So I don't want it in the market because it's too risky. I don't want my moving plans to be impacted by the stock market. I don't want to keep it in the bank because they're not paying me anything. Let's get a 5-year MYGA, right? So I'm looking at short-term rates. Okay. So what I want to do quickly, and this is going to be a short show, Tony, because I know what you're going to want to do is you're going to take this info and you're going to go right away and start shopping around for these because I know you. So I don't want to hold you back, They have, like record day, they have MYGA day. So people line up outside the insurance companies and try and get the best interest rate once a year.
That's not true.
Okay, so what do you think MYGA rates are doing currently, Tony, with the Fed raising interest rates across the board for borrowing money? What do
I
you
would
think
assume
MYGA?
I would assume they're going up. I mean, not the existing MYGAs that people have, but if you get a MYGA today, I would assume it would pay more interest than it did 3 years ago.
You know, you made a very good point. If you bought a MYGA, a 3-year MYGA, a 3-year fixed rate last year, you're locked in
Yeah,
that fixed rate. Your interest rate's set. That's not going up. It's
you're
not going
missing the
down,
upside.
right? So you're locking in, right? You're right. So that's a good point. But you're also right about, did I say that twice? You were right twice. They are going up. So what I've done is I've looked on, and there's a link there. You can follow this. You can go and look yourself. You can put different timelines in. These are annuity rates, MYGA rates, and I compared um, August, or no, I should say May of 2021 to May of 2022. So where were 3-year MYGA rates last year versus now? And the average rate in May of 2021 was 1.5% for 3 years. So you'd lock in 1.5% for 3 years. Not very sexy. Now,
No,
compared to a CD, that probably was triple, quadruple the rate you'd get at a CD,
at
but for
least
the same
double.
timeline, right? Now, 1.5% last year, this year, 2.74% for a 3-year. This is the
Mm,
average across the nation.
mm.
Okay. That's an 82% increase since last year.
Wow, that's big.
Mm-hmm.
But,
Right.
you think, "Hey, that sounds great," but when inflation's at over 8%,
Right. Where did inflation
ear
come from and go
earning
to?
earning earning 2.74%, not so good.
Right. We just did a show recently on inflation, and we talked about how you got to keep some stuff at risk to stay up with inflation, but keeping cash or keeping money in a bank is not going to help. This
No.
is not keeping up with inflation. 2.74% for the a 3-year rate is not keeping up with inflation by any
But
stretch.
your principal is protected in a MYGA, right?
It's oh yeah, right. So you're going to get 2.74. There's
So you're
no
getting safety in exchange for that lower interest rate,
right. But
or
and it's not
possibly.
going to keep up with inflation, but it's going to do better than money in your pocket,
Yeah.
right? So
And it
you're
could do better than
reducing
money in the stock market depending on what stocks you have
right, right.
and what day of the week it is.
So again, what do you want one of these? What's the purpose, right? So let me also show you the highest rates. This is the highest MYGA rates at the time. So a year ago in May, if you wanted a 3-year MYGA, the highest rate was 2.85%
Mm,
with one particular company. I'm not going to name names, but that rate has now, I think it might even be the same company. It might be a different company, but 3.5. So that's about a 22% increase for the top paying company. So you start looking at this and say, all right, I can lock in 3.5% for the next 3 years. Now, if you said that a year or two ago, hey, I'll give you 3.5% for 3 years, people would jump on it
yes,
because they couldn't. I mean,
because interest rates were so low,
right.
almost non-existent.
So, you can get 4% or more if you go out 5 years or 10 years, right? But then you
Right.
say to yourself, okay, where are interest rates going? No one knows, right? No one knows where interest rates are going. But the Fed has indicated we're going to continue to raise rates to combat inflation. So if you know that interest rates are going up, do you want to lock in for a 5-year or a 10-year MYGA for that extra interest? I don't know.
Mm,
Right. So that's why I look at the 3-year rate because that's a decent time. That's
sure.
short term by a lot of stretch of the imagination. And it's also, and you could go a 2-year MYGA, the rates are lower. But if you're thinking about, hey, what am I going to need income for in 3 years? Maybe you're retiring in 3 years. Maybe you're moving. Maybe you need to buy a new car in 3 years. Maybe you want to remodel the kitchen in 3 years. right?
So
And
rather
so
than let that money sit in a savings account,
right,
what you would do is you could put it in a MYGA for 3 years and earn some more interest on it, and then in 3 years when you're ready to meet that goal you set to buy a car or a house or, to send your kid to college, then you pull that money out and it's earned that, um rather than risk the market being down the year or the time rather than leave people will say, "Well, I've got it in the market in an IRA or a mutual fund.
right,
Why not just leave it in there and then I can earn more?" Well, but can you? Is it gonna be down? Is the
right.
market
There's
gonna be down
right.
20% when you
Right, you're right, timing is everything,
Yeah.
so you
Yeah.
try rather than trying to so you could buy a bond, you could ladder some bond portfolios, but interest rates are going to impact bond prices,
Yeah,
so
as they
there's
g
a
as
little bit of
interest rates
risk
go
there.
up, bonds pay less, right?
Well, bonds pay more, but the ones you own are
Oh,
worth
yeah, the
less
ones
because
you
people will
own go
sell it, right? The
Yes.
pressure right?
Yeah,
So, yeah, so these rates ha they impact retirees in particular because they're not working anymore, and so they don't their income is set, and so they have a shorter time horizon for a lot of things. So they're not willing to take the risks associated with the higher returns. You can look at the like I said in the beginning, you can look at the I Series I bonds and get interest that's pegged to inflation. You can get a U.S. Treasury paying 8-9% right now, but that resets every 6 months. But you can only put 10 grand in there. So if you wanna put more than that, I mean, you're limited, so a year. So here you can put whatever you want into it, and it's a good short-term vehicle. Now, there's ups and downs to these, but I wanted to bring it up, not because I'm saying these are the greatest things in sliced bread. Um, I wanted to bring it up because I want people to know that these things really move in pricing.
sure.
I have software that gives me the latest rates, and every 2 weeks, they're changing. And these insurance companies are trying to remain competitive, and because they know people shop these around like they shop CDs around. So if you're thinking about it, you're going to want to shop it around. The big question I have for you, Tony, is why do you think that these aren't popular? Or why do you think people don't know about these? Because I don't think a lot of people know about MIGAs.
Because people assume that I think people are just in the one reason, this is maybe not the reason you're looking for, but I know as a fact, one reason is the mindset out there is for growth, I put it in the stock market. For safety, I put it in a savings account or a CD. And that's the mindset. Also, another reason is, oh, you said insurance. You're trying to sell me something. I'm going to put money in and not be able to get it all back out. There is a stigma when
Yeah.
people hear the word insurance. So I think those are two roadblocks that are misconceptions. I mean, obviously, there are great insurance products, and there are insurance companies that are going to be around longer than some banks and have been.
Yeah.
So the whole FDIC thing and insurance thing, for me personally, um, I think you know, that's neither here nor there. People who speak badly about annuities say, well, it's not insured by the FDIC. And it's just like, you find me somebody with an annuity who didn't get their money back because the insurance company went under. You won't, because insurance companies also have companies, a third party that insures the money up to at least a point, and if they're not doing well, they get bought out. So, and your money is with that other company, and it's still there. So, I just think there are roadblocks that aren't legitimate when it comes to annuities in general. I mean, is that what you were thinking,
Yeah,
or?
no, I those are definitely legitimate reasons why there's a stigma, and
Mhm.
but I'm going to put another nefarious reason out there that you don't hear a lot about these. Because if you compare it to a CD, I mean, they're two different products, right?
Right,
But
right.
they're similar, so you can do the comparison. But if you think about it, a bank is not going to banks like CDs because let's be real, the interest rate's pretty darn low. So they're
Right.
making more on the money, right? So they're a money maker for the bank.
Yeah.
Who's making money off the a MYGA? The insurance companies, yeah, they make a little bit more than they pay out for sure, but they're paying out so much more than the CD. Why aren't they more popular? It's because how do you get an annuity? You go through an insurance agent, so there's a stigma there, like you said, insurance agent. But do you know, and I bet you can figure it out, that there's a lot of other types of annuities that pay a whole lot more to the insurance agent than a MYGA pays in the form of
Yes.
commission.
Yeah.
So you don't get a lot of money by
Variable.
selling one.
Oh,
Well, you don't get a lot of money by selling this type of annuity compared to others.
sure.
So they're
Yeah.
viewed as, I don't really like them.
Yeah,
Why not?
when you deal with salespeople, it's tough, and
Right.
that's why. And this is a great place to. I know you don't like to plug. The show is about information for and education for our listeners, but this is why you need to work with a financial services professional who's looking out for your best interests, not just an insurance salesman.
Right.
A financial planner who looks at not just stocks but also other options like CDs, like Social Security, like your pension, to help you maximize these things, like taxes to minimize. And so if a MYGA is the best possible route for somebody wanting to do something, you'll recommend it. You're not there to sell it, because that's not how you make the majority of your living. You want them as long-term clients. So when their overall investments do better, then you make a small percentage, and that's how you get paid. And you're very transparent about that. So I want to encourage our listeners, and I'm not saying they have to call you, they should, but work with a trusted financial services professional before you do anything, right, with
Right.
your
Work with
money.
someone that's going to look at all the options and say, yeah, let's talk
Yes.
about precious metals. Let's talk about stocks. Let's talk about bonds. Let's talk about annuities, and let's figure out which way to go. And if the answer is I need a fixed annuity or a MYGA, then all right, find an insurance agent and go buy it. Right.
Yeah.
But don't lead with the insurance agent, because they're not going to talk. They're not allowed to talk about investing in other things. Right.
Yeah.
So that it's just, you're right.
They're
It's
just going
so
to
that
sell you the
I
product that
wanted to
makes
bring
them
that
the
up.
most commission. Yeah.
I wanted to bring that up because a lot of people are wondering, well, why don't I hear about this? It must be bad.
Yeah. I hear
Eh,
about variable annuities and fixed index annuities a
right,
lot.
but you don't hear about MYGAs, and my take is that obviously people don't understand them and that sort of thing, but it's also because the compensation for selling them is quite low.
Yeah.
So, because how much room do you have? I mean, if you're
Right.
paying 3%, like what, right? So, okay, conclusion. So rising interest rates do impact annuities. They do impact pensions. So as interest rates are going up, you got to be aware of this. You
Yeah.
got to double take about buying a long-term annuity. Think through that. And also know that by shopping and maybe laddering, you can keep up with this rising inflation and the in prices that are increasing. Don't lock in all your money in a 10-year.
Right.
Maybe do some laddering, right? It pays to understand what type of annuity you're looking at and shop around. Don't just jump on the first thing you hear,
Right.
right? Expect. So that's another thing. If you decide, hey, I want a MYGA, don't go to company XYZ's agent. Go to a broker that can shop all the companies, right? Because the
Right.
XYZ agent's going to say this XYZ company's annuity is better than everyone else's. Well, what about that company? They're offering, 30% more interest. Why wouldn't I do that? Well, because they're not me, right? So again, and then you got to factor in, expect, what do you think's going to happen? Look at the signals, think about it, talk to a financial advisor and say, what do you think the interest rates are going to be doing? And how does that impact me today with locking in rates now? Right. So you just don't buy these things willy nilly. You have a purpose for buying them.
Right.
I need money in X years. Where do I put it? I need money in 10X years. Where do I put it? Right. So again, this is just, it's almost, I we joke about the A word, right? As there, no one likes annuities, no one wants to talk about it. But when you think about it in terms of like a MYGA or multi-year guarantee annuity, you kind of see, wait, I get it now, right? This is
Yeah.
what, when I tell people about these, they say, oh, well, what's the catch? Catch is, just like every other annuity, you got surrender charges, you got to worry about what insurance company, you got to know the terms. But if you're comfortable with the terms, why wouldn't you dabble in it?
Yeah. It's just like anything else.
It's
Yeah.
just like anything else.
Yeah,
So,
yeah,
you know
it's a great basic product that can really help people
yeah,
financially. It's a great tool, but the point you're trying to make, and the best analogy to use that I've heard is the toolbox analogy. So people are
yes,
like, why wouldn't you have this need, and let's say your need is you've got a drywall screw, and it's got a Phillips head, it's got a star driver. So but you don't like the star driver or the Phillips screwdriver. You look in the toolbox, you're like, I don't like that. That's purple. I don't like that color. It's obnoxious. I don't want to be seen using that screwdriver. I've heard bad things about Phillips screwdrivers, so I'm going to use a hammer. I like the hammer. I've heard good things about the hammer. And so basically, someplace people, all they look in the toolbox, they don't have a screwdriver. All they have is a hammer. And my dad always said, Dan, that if all you have is a hammer, everything looks like a nail.
That's right.
And that's the way it is with financial tools. And you need to use the right financial tool for the right to reach the certain goal, the one that's mathematically going to make you the most money, keep you the most money, and get it to you when you need it, right?
Right. You're right. You're right.
Yeah.
It's a great analogy. If all you
Yeah.
have is a hammer, everything looks like a nail.
Yeah.
And that's what you don't want a hammer salesman when
Yeah.
you have a drywall screw issue.
Insurance salesman. Oh, okay.
All right, Tony. Thanks for staying awake during an annuity conversation.
I stayed
Sorry
awake.
for using the A word so much, but you know, as an Anthony, you hear it a lot. But, you know. On that note, let me remind everybody that I do have, I am a fiduciary. I do look out for everyone's best interest, but that makes me have to have disclosures, and I have my sons read it. So let's bring in the kids.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Whittle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.